Venture capital's growth at all costs. The unicorns that never were, and your money they ate.
An examination of the speculative bubbles, inflated valuations, and fear of missing out culture. Within the North American venture capital landscape, this video will explore how startups are often propped up by rounds of funding, only to collapse, leaving retail investors or pension funds to bear the ultimate losses. It is a tale of magical thinking and abundant capital.
The great American myth. Breeding unicorns on speculative dreams.
Welcome, discerning investors and cynical observers, to the fantastical realm where venture capital reigns supreme and the elusive unicorn is the most coveted beast. This is not merely a segment on startup investment. It is an unvarnished examination of the great American myth, rebranded for the digital age. It is a tale of magical thinking, abundant capital, and the relentless pursuit of hypergrowth companies, often at the expense of grounded financial reality. Prepare for an expose, designed for those who appreciate financial insights, unburdened by corporate spin. The term unicorn itself, coined in 2013 to describe privately held tech companies valued at $1 billion or more, has become an almost religious idol in the North American venture capital landscape. What began as a rare phenomenon has transformed into an expected outcome, self-fulfilling prophecy fueled by boundless optimism and an even more boundless supply of cash. This pervasive narrative suggests that America, the land of opportunity, can endlessly produce these mythical creatures, each one destined to revolutionize an industry and generate unprecedented wealth for its early backers. It is a compelling story, one that whispers promises of overnight riches and entrepreneurial genius, effectively hypnotizing a significant segment of the investing public. At the heart of this modern myth are the venture capitalists, the high priests of the startup world. They are the individuals who identify, fund, and ostensibly guide these fledgling enterprises towards their billion-dollar destinies. Their pitch is polished, their portfolios are often celebrated, and their track records, when successful, are astronomical. They operate under a specific, almost Darwinian philosophy: invest in many and expect most to fail, but anticipate that the one or two massive successes will more than compensate for the numerous casualties. This home run mentality is foundational to speculative bubbles in the tech sector, implicitly encouraging outsized bets on unproven concepts. This strategy, while potentially lucrative for the VCs themselves, inherently pushes the boundaries of prudent investor risk. What truly propels this frantic hunt for unicorns is a unique brand of magical thinking that permeates the entire ecosystem. It is the belief that a compelling vision, coupled with aggressive user acquisition and a dazzling pitch deck, can somehow supersede traditional business fundamentals such as profitability, sustainable revenue, or even a clear path to market dominance. In this world, the valuation of a company often becomes a performance art. A startup with minimal revenue, or even substantial losses, can command hundreds of millions in funding purely on the back of its potential to disrupt an established industry. The conventional metrics that financial analysts have relied upon for decades are dismissed as antiquated, replaced by nebulous concepts like total addressable market or eyeball share. This detachment from tangible financial performance allows for inflated valuations, where perception and hype frequently outweigh reality. This phenomenon is massively exacerbated by the sheer abundance of capital flowing into venture funds. In an era of historically low interest rates and increasingly complex financial markets, institutional investors, including pension funds and university endowments, have poured vast sums into venture capital in search of higher returns. This deluge of money means that VCs have more funds than ever before to deploy. The competitive pressure to invest these substantial war chests creates a palpable FOMO, fear of missing out. No venture firm wants to be the one that overlooked the next big thing, leading to a frenzied race to fund promising, or sometimes merely popular startups, frequently driving up their valuations to dizzying heights even before they have a viable product or sustainable business model. This herd mentality means that critical due diligence can become secondary to simply participating in the hot rounds. Consequently, we witness a proliferation of these billion-dollar paper tigers. Companies whose valuations are built more on the fervent belief in future growth than on present-day financial health. They are the progeny of a system where potential is prized above profit, where market share is deemed more vital than earnings, and where the promise of tomorrow justifies the burning of capital today. It is a compelling illusion, one that has captivated the American imagination. But like all magic tricks, it eventually requires a reveal. The question, for those of us seeking unvarnished financial insights, is not if these speculative dreams will face reality, but when. And more importantly, who will be left holding the bill when the magic fades and the unicorn reveals itself to be merely a very expensive, albeit flashy, pony.
Growth at any price. How valuation became more important than profit.
Good day, fellow architects of financial insight and connoisseurs of market cynicism. We now delve deeper into the peculiar alchemy of venture capital, specifically dissecting the pervasive mantra that has warped the landscape: growth at any price. This is not merely a strategic choice. It is a fundamental reordering of financial priorities, where the ephemeral glow of startup valuation has eclipsed the very tangible substance of profitability. For the astute North American observer, this shift represents a profound departure from traditional economic principles, a narrative where perceived momentum, rather than proven performance, dictates destiny. Historically, a business was judged by its capacity to generate more revenue than it consumed, producing a healthy bottom line. This quaint notion of sustainable business formed the bedrock of financial analysis. Profits signaled efficiency, market demand, and a viable operational model. Then, the digital age dawned, bringing with it a torrent of abundant capital and a compelling, if ultimately dangerous, new philosophy. The argument became establish market dominance first, capture every available user, and profitability will eventually follow like a grateful puppy. This was the genesis of growth at any price. The implementation of this doctrine saw a dramatic shift in what constitutes a successful metric. Instead of earnings before interest, taxes, depreciation, and amortization, EBITDA, we began celebrating daily active users, DAU, monthly recurring revenue, MRR, and the sheer velocity of revenue growth, even if every dollar of revenue came at a cost of $2 spent. Companies were encouraged, indeed rewarded, for expanding their operations at breakneck speed, entering new markets, acquiring smaller competitors, and launching innovative or merely novel features, all while bleeding cash at an astonishing rate. This relentless pursuit of scale, often devoid of any immediate prospect of self-sufficiency, became the primary indicator of a startup's potential. Why did this paradigm take root so firmly? Primarily, it is an ingenious mechanism for amplifying startup valuation. In the venture capital ecosystem, higher valuation on paper translates directly into greater perceived success for the fund managers, larger management fees, and more attractive pitches for their next fund. If a company can demonstrate hypergrowth, even if unprofitable, it can justify successive larger rounds of funding at ever-increasing valuations. Each new funding round becomes a validation of the prior round's valuation, creating a virtuous or vicious, depending upon your perspective cycle. The growth is the story, the valuation is the proof of the story's market appeal, and the actual profitability becomes a distant, often abstract concern for a future generation of management. Consider the spectacle. A company with an astronomical burn rate, meticulously spending millions to acquire customers who may or may not ever yield a net positive return, is lauded as a disruptor. Its investment strategy is not about efficient capital allocation, but about aggressive market conquest. The belief is that once critical mass is achieved, once the competition is sufficiently sidelined, then, and only then, can prices be raised, costs be cut, and the mythical pathway to profit be forged. This is the ultimate gamble, betting that the future market structure will be so favorable that past inefficiencies can be miraculously absolved. It is a thrilling, albeit financially precarious, tightrope walk. This prioritization of valuation over profit has profound implications for financial analysis. Traditional metrics, designed to assess the health and sustainability of a business, are often dismissed as irrelevant for these high-growth entities. Analysts are pressured to invent new, often bespoke metrics that showcase positive trends, however superficial. The story replaces the spreadsheet, Potential replaces the balance sheet. And in this environment, it becomes incredibly easy for even experienced investors to succumb to the allure of the narrative, overlooking the fundamental fragility beneath the shiny facade of rapid expansion. This subtle form of financial manipulation is not about fraud, but about the clever redefinition of success, guiding perceptions towards a manufactured reality. The ultimate irony is that for many of these unicorn companies, the pursuit of growth at any price often leads to a precipitous fall. When the abundant capital inevitably tightens, or when market sentiment shifts away from speculative ventures towards proven models, the lack of underlying profitability becomes a crippling liability. These entities, having never learned to stand on their own to financial feet, suddenly find themselves without the constant IV drip of external funding. Their impressive valuations, once celebrated on paper, evaporate with brutal efficiency, leaving behind a trail of disillusioned investors and squandered resources. The price of growth, it turns out, can indeed be everything. We are left then with a crucial lesson. The siren song of rapid expansion and billion-dollar valuations, while undeniably seductive, often conceals a dangerous void. For the discerning investor, understanding this insidious reordering of priorities, where the dazzling valuation momentarily eclipses the mundane, essential act of generating profit is not merely academic. It is a critical defense against the mirage of the tech bubble and a safeguard against becoming another casualty in the relentless and often ruthless quest for growth at any price.
The FOMO casino, where everyone bet big on the next big thing, even if it was not.
Welcome back, enlightened patrons of Unvarnished Financial Truth. We now pull back the curtain on one of the most potent, yet insidious, forces driving the contemporary venture capital landscape: the fear of missing out, or FOMO. This is not merely a passing sentiment. It is a full-blown psychological pandemic, turning what should be prudent startup investment into a high-stakes, emotion-driven FOMO casino. Here, logic often takes a backseat to narrative, and everyone is betting big on the next big thing, even when objective analysis suggests it is anything but. The human psyche, as we know, is exquisitely susceptible to herd behavior. When a buzz begins, when a narrative gains traction, and especially when others appear to be prospering from participation, the urge to join becomes almost irresistible. In the world of tech investment, this phenomenon is amplified to an extreme degree. Stories of early investors in companies like Facebook or Google becoming overnight billionaires serve as modern parables, creating a powerful emotional trigger. What if this is the next one? What if I miss out on that life-changing opportunity? This question, whispered by our subconscious, is the sacred scripture of the FOMO casino. Venture capitalists, those esteemed gatekeepers of abundant capital, paradoxically both victims and perpetrators of this collective delusion. While their primary directive is to identify and fund genuinely disruptive innovations, the competitive pressure within their own industry often dictates otherwise. No fund manager wants to be the one who passed on a seemingly hot deal that later soared to unicorn valuation. This internal fear of missing out creates an environment where due diligence can sometimes become cursory, placed by a desperate scramble to secure an allocation in the most talked-about startup funding rounds. The perceived prestige of being associated with a popular startup, even one burning through capital at an alarming rate, can override the sober assessment of its fundamental viability. This emotional contagion leads directly to inflated valuations. When multiple venture funds, all suffering from acute FOMO, vie for a slice of the same pie, the price of that pie inevitably skyrockets. A company with nascent technology, unproven business models, and perhaps a small customer base can suddenly command hundreds of millions, or even billions of dollars, simply because it is deemed the next big thing. This valuation is not tethered to current revenue, profitability, or even a clear path to market dominance. It is a product of collective aspiration and the shared anxiety of being left behind. The market, in essence, becomes a giant auction, where the final bid is determined less by intrinsic value and more by who suffers the most from irrational exuberance. Consider the mechanics. A charismatic founder presents a vision, perhaps leveraging AI, Web3, or some other currently fashionable buzzword. The narrative is compelling, the potential market is enormous, and the team possesses an undeniable swagger. Rather than meticulously scrutinizing unit economics or long-term competitive advantages, investors succumb to the emotional appeal. They see not a business, but a lottery ticket. They hear not a strategy, but a prophecy. This is not investing. It is sophisticated gambling, dressed in business attire, played with other people's money. The sheer volume of liquidity circulating in the system ensures that there is always another round, another investor willing to take a chance, extending the life of even the most questionable ventures. This speculative investing environment fosters a perverse incentive structure. Founders are incentivized to prioritize hype over substance, to craft narratives that spark FOMO rather than build sustainable enterprises. Their success is measured not by revenue or profit, but by the valuation achieved in their latest funding round. This can lead to a focus on vanity metrics, aggressive marketing spend to boost user numbers, and a general disregard for financial discipline, all designed to perpetuate the illusion of unstoppable growth. The objective becomes raising the next round at a higher valuation, rather than creating genuine long-term value. Ultimately, the FOMO casino thrives on the hope that someone else, later down the line, will be even more susceptible to the same fear. Public pension funds, institutional investors, and even individual retail investors, through various indirect channels, are often the ones who eventually inherit these overvalued assets. They are the unwitting participants in a game where the early players, the venture capitalists, have already de-risked their positions, often selling shares in later funding rounds or through direct listings. When the music stops, when the market corrects, or when the next big thing proves to be a mirage, it is these later entrants who bear the brunt of the losses, left holding the bag for dreams that never materialized. The cautionary tale here is clear. While innovation is vital, and risk-taking is essential for progress, blind adherence to the fear of missing out transforms prudent investment into a dangerous game of musical chairs. For those seeking genuine financial insights, it is imperative to disengage from the herd, to question the narrative, and to demand substance over sizzle. Only then can one navigate the treacherous waters of the FOMO casino without becoming yet another casualty of its enticing, yet often hollow, promises.
The financial architecture of risk transfer. How VC externalizes its failures.
We have thus far navigated the fantastical realm, where venture capital crowns its mythical unicorns, witnessed the fervent worship of growth at any price, and explored the psychological abyss of the FOMO casino. We have observed how nascent enterprises, often devoid of tangible profitability, ascend to dizzying valuations on the mere vapor of potential and the intoxicating perfume of hype. Yet, as with any spectacle of illusion, a crucial question invariably arises. When the magic fades, and the unicorn reveals itself to be little more than a very expensive donkey, who precisely bears the ultimate financial burden? The answer, dear discerning reader, lies in what we shall now dissect. The financial architecture of risk transfer, how VC externalizes its failures. Make no mistake, venture capital is inherently a game of calculated risk, albeit often with an audacious disregard for conventional prudence. The foundational philosophy, as previously noted, dictates that many investments will fail, but a select few home runs will compensate for the multitude of casualties. This is a perfectly rational strategy for the venture capitalists themselves, whose compensation structures are often tied to the overall performance of their fund, not the individual success of every single portfolio company. Their brilliance, however, often resides not merely in identifying potential winners, but in constructing an ingenious financial architecture that systematically externalizes the risks of their inevitable failures onto less sophisticated, or perhaps merely less nimble, participants in the capital markets. Consider, if you will, the typical life cycle of a venture-backed startup. Early-stage funding rounds secured by the VC are indeed high-risk, high-reward propositions. The venture capitalist, acting as an early investor, injects capital in exchange for equity. The hope, naturally, is for an exponential return. But what happens when the celebrated disruptor merely disrupts its own balance sheet into oblivion? Does the venture capitalist simply accept a total loss? Not necessarily. The financial ecosystem is replete with mechanisms designed to ensure that the initial risk takers often have avenues to mitigate their exposure long before the ultimate implosion of a paper tiger. This is where the artistry of risk transfer truly shines. One of the most potent tools in this architecture is the subsequent funding round itself. As a startup gains traction, or at least the appearance of it, additional rounds of financing are sought. These later stage rounds, often at substantially increased valuations, serve multiple purposes. For the startup, they provide more capital for its growth at any price strategy. For the early stage venture capitalists, however, they present a crucial opportunity: partial liquidity. Through secondary share sales, early investors can offload a portion of their holdings to new investors, often larger institutional players, like mutual funds, hedge funds, or even sovereign wealth funds, who are eager to participate in the perceived success story. The initial VC, therefore, takes some chips off the table, locking in a return, while simultaneously passing the baton of risk to the next eager participant. It is a shrewd maneuver, allowing them to benefit from the inflated valuation without having to hold the entire bag till a public offering or acquisition. This elegant transfer is further facilitated by the very opacity of private markets. Unlike publicly traded companies, the valuations of privately held unicorns are often subjective, determined through negotiation between founders and investors, rather than the relentless scrutiny of public markets. This relative lack of transparency, coupled with the fear of missing out that pervades the ecosystem, creates fertile ground for later-stage investors to accept these valuations, sometimes overlooking fundamental weaknesses. When everyone is desperate to get a piece of the next big thing, detailed due diligence can be conveniently curtailed, replaced by the collective delusion that a higher price simply equates to greater future promise. The role of regulatory environments, or indeed the strategic absence thereof, in this architecture cannot be overstated. While outright financial deregulation, as we discussed previously, enables broad predatory practices across the financial sector, its particular impact on the venture capital realm is often more nuanced. It manifests in the limited oversight of private capital markets, the lax disclosure requirements for privately held companies, and the freedom to engineer complex investment vehicles that can further obscure the true liabilities. These regulatory lacunae allow venture capitalists to operate with considerable latitude, crafting deal structures that prioritize their own exit routes and downside protection, often at the expense of later-stage investors who may not possess the same bargaining power or access to information. Ultimately, this financial architecture creates an elaborate game of hot potato, where the initial highly speculative investments are systematically de-risked by the original venture capitalists and passed on to progressively larger, and often less risk-averse investors. The venture capitalist, the master architect, skillfully constructs the pathway for this transfer, ensuring that by the time the unicorn finally collapses, they have either exited entirely or significantly reduced their exposure. It is not necessarily fraud, it is simply a highly efficient, some might say ruthless, mechanism for privatizing the spectacular gains while strategically externalizing the colossal losses. The question then becomes, as we approach the inevitable reveal, who precisely is left holding the perpetually burning embers when the game of musical chairs concludes? It is this lingering question that shall propel us into our subsequent deliberation, focusing squarely on the unfortunate entities who become the ultimate recipients of this carefully constructed risk transfer.
The socialized debt, public and pension fund exposure to unicorn busts.
Having meticulously unraveled the ingenious financial architecture designed to transfer risk from the audacious few to the unsuspecting many, we now arrive at the inevitable, and indeed rather unsavory, culmination of this venture capital grand illusion. We speak, of course, of the socialized debt, public and pension fund exposure to unicorn busts. For when the dazzling promise of hypergrowth inevitably collides with the unyielding reality of market forces and the ephemeral glow of startup, valuation evaporates with the brutal efficiency of a popped bubble. It is often not the initial high priests of the startup world who bear the brunt. Instead, the bill for these speculative dreams, the cost of these mythical creatures that never truly were, is frequently footed by the very institutions entrusted with safeguarding the financial future of ordinary citizens. The mechanism by which this debt becomes socialized is both predictable and, for those with a cynical appreciation for financial maneuvering, rather elegant. In an era characterized by historically depressed interest rates and the relentless pursuit of superior returns, Institutional investors, specifically public and private pension funds, university endowments, and other large pools of capital, have found themselves in a rather uncomfortable predicament. Their mandate is clear: generate substantial returns to meet future liabilities, be they retirement benefits for teachers and firefighters, or scholarships for bright young minds. The traditional lower-risk avenues often fail to deliver the requisite yield. Enter the siren song of venture capital. Venture capitalists, ever the master marketers, present a compelling narrative to these institutional behemoths. They paint a vivid picture of astronomical returns, citing the legendary successes of the past, the Facebooks, the Googles, as irrefutable proof of venture capital's transformative power. The argument is simple: allocate a small percentage of your vast holdings to this alternative asset class and partake in the burgeoning wealth of the digital revolution. Such an opportunity, they assert, cannot possibly be missed. And thus, propelled by a blend of genuine return-seeking and an acute case of FOMO, these custodians of public wealth pour billions, perhaps even trillions, into venture capital funds as limited partners. This involvement is not always direct. Sometimes pension funds invest in larger funds of funds that then allocate capital to various venture firms. Other times, they participate in later-stage funding rounds of highly touted unicorns, drawn in by the seemingly validated valuations of prior rounds. Regardless of the precise conduit, the underlying dynamic remains consistent. Public and pension funds are frequently positioned as the ultimate buyers of optimism, acquiring equity in companies whose valuations have been inflated by successive rounds of capital, all predicated on future, often theoretical growth rather than present tangible profitability. They become the deep pockets ensuring that the venture capitalists can achieve their early-stage exits. As discussed in the preceding analysis, by providing the liquidity necessary for these early investors to take some chips off the table, when the inevitable unicorn bust materializes, the consequences ripple outwards with devastating clarity. A company, once celebrated for its disruptive potential and its ability to burn cash at a prodigious rate, suddenly finds itself without a continuous intravenous drip of external funding. The underlying business fundamentals, long ignored in favor of eyeball share and total addressable market, are exposed for their profound inadequacy. The once astronomical valuation, sustained by market sentiment and the belief in a perpetually favorable future, collapses. It is at this juncture that the concept of socialized debt truly manifests. The venture capitalists and early founders, having often structured their investments and compensation to allow for partial or full exits during earlier, highly valued funding rounds, have frequently insulated themselves from the ultimate reckoning. They privatize the gains, securing their wealth and enhancing their prestige. The losses, however, are effectively nationalized. They land squarely on the balance sheets of those institutional investors who bought in at the inflated valuations, hoping to catch the final, exhilarating upward trajectory. The tangible impact on ordinary citizens cannot be overstated. When a public pension fund suffers significant losses from its venture capital portfolio, the ramifications are not confined to a spreadsheet. It means less money available to pay the retirement benefits of teachers, police officers, and civil servants. It means increased pressure on taxpayer money to bridge the funding gaps, potentially leading to cuts in public services or increases in taxes. For private pension funds, it translates into diminished retirement savings for millions of workers. The unseen consequences are not merely financial. They erode the social contract, fostering a profound sense of injustice, where the speculative gambles of a privileged few are subsidized by the secure retirement hopes of the many. This relentless transfer of risk, orchestrated through an elaborate financial architecture and culminating in the socialized debt of unicorn busts, creates a system where profits are meticulously privatized, but losses are systematically externalized. It is a cynical, yet immensely effective mechanism for maintaining the illusion of boundless innovation and wealth creation, while subtly shifting the inherent volatility and failure of highly speculative ventures onto the broad shoulders of the public. This, dear reader, is precisely how the unicorns that never were managed to consume your money. It is not magic. It is simply a very expensive lesson in who truly pays when the market's enthusiasm for mythical beasts invariably wanes.
The great VC illusion when your savings fund their failures.
This exploration into the venture capital ecosystem has peeled back the layers of alluring narratives, revealing a complex mechanism where speculative dreams often morph into financial burdens for the many. We have examined the pervasive unicorn myth, the relentless pursuit of growth at any price, and the intoxicating FOMO casino, all of which contribute to a systemic detachment from grounded financial reality. The central revelation is this: the venture capital model, while promising unprecedented wealth for some, is architected to transfer its inherent risks from early, shrewd investors to broader, often unsuspecting segments of the financial market. It is imperative for every discerning individual to comprehend this architecture of risk transfer. Venture capitalists operating with strategic acumen often utilize successive funding rounds and the opacity of private markets to mitigate their own exposure. They frequently secure partial liquidity by offloading their holdings to new investors, including large institutional players such as public and private pension funds, as well as university endowments. This means that while early gains are privatized, the substantial losses from failed unicorns often become socialized debt, impacting the retirement security and public services upon which many rely. Recognizing this systematic shifting of financial responsibility is the initial step towards safeguarding one's own economic well-being against the volatility of speculative capital. Do not be mesmerized by the dazzling valuations. Instead, scrutinize the underlying fundamentals and the ultimate destination of risk. The understanding of how venture capital externalizes its failures is not merely academic. It is a call to immediate action. The stability of our collective financial future, especially the integrity of pension funds and public investments, hinges upon demanding greater transparency and accountability within these opaque markets. Engage with the mechanisms that govern your retirement savings and public funds. Question investment strategies that prioritize ephemeral growth over tangible profitability. This knowledge empowers you to advocate for more prudent oversight and to resist the allure of overvalued assets that lack sustainable business models. Your vigilance is a critical defense against becoming an unwitting participant in a system designed to transfer speculative risk. The bill for unchecked speculative endeavors invariably comes due, and it is crucial that you are not the one left paying for another's magical thinking. Empower yourself with this vital insight. If this deep dive has resonated with you, please consider giving this video a like to signal its importance. Subscribe to the channel to continue receiving unvarnished financial truths and critical analyses. Share your thoughts and questions in the comments section below. Your perspective contributes significantly to this ongoing dialogue. Furthermore, share this video with your friends, family, and colleagues. Spreading awareness is the first and most powerful step towards demanding a more equitable and stable financial future for all. Your active engagement makes a difference,